If fuel prices jump, if phones suddenly cost more, if imported clothes quietly disappear from your budget, it's not random, and it's not just inflation. It's usually one thing happening first. Big money is leaving the country. And when that happens, your currency weakens. When your currency weakens, everything you buy from abroad becomes more expensive. Fast. This doesn't start with panic. It starts quietly, long before most people realize what's going on. In this video, I'm going to show you the exact chain reaction that turns money leaving a country into higher prices in your everyday life. Not theories, not politics, just the mechanics. You'll learn why prices rise before headlines change, what signals appear early, and how this same pattern has repeated across countries decades apart. Once you see it, you'll start spotting it in real time. Here's the simple model. No history yet, just logic. First, large investors move money out of a country. Second, demand for that country's currency falls. Third, the exchange rate weakens. Fourth, imports become more expensive immediately. Nothing else has to change. Wages can stay the same. Production can stay the same. But because imports are priced globally, your currency now buys less of them. Fuel rises first, then electronics, then spare parts, medicine, machinery, food inputs. This is not opinion, it's math. Let's look at an early example. This was a country deeply tied to global trade. Foreign merchants trusted its currency for decades. Then costs rose, debt expanded, confidence quietly shifted. The wealthiest traders didn't wait for collapse. They moved capital abroad, slowly at first. As that money left, the currency weakened. Imports started costing more. Merchants raised prices just to stay solvent. Ordinary people didn't know why daily life felt harder. But the damage was already done. By the time the public noticed, purchasing power had already been lost and never fully returned. Now a second case, more financially advanced. This country was once a global banking hub. Capital flowed in from everywhere. But success brought strain. Spending increased. Debt piled up. Insiders saw the imbalance early. Capital moved out. Quietly, methodically. The currency weakened. Because the economy relied heavily on imports, prices surged. Fuel rose. Materials rose. Finished goods followed. People blamed inflation. They blamed merchants. They blamed politics. But the cause came earlier, when capital left. Same sequence. Same result. Now a modern example. This economy was seen as safe, stable, untouchable. Its currency was trusted worldwide. Then wars, long-term debts, and structural costs changed the outlook. Corporations began expanding elsewhere. Families diversified assets internationally. Investment quietly shifted. The currency weakened, not overnight, but steadily. Imports reacted immediately. Fuel prices climbed. Technology became expensive. Food costs followed through supply chains. The exchange rate didn't predict the future. It revealed what had already started. Now bring this to the present. Modern economies import more than ever. Energy, electronics, medicine, machinery. At the same time, capital moves faster than at any point in history. When large investors sense rising risk, they don't debate it. They reposition. When enough of them do that, the currency feels it. That's why you can see higher prices even before official inflation spikes. The exchange rate did the damage first. This is why everyday life gets more expensive before the crisis feels obvious. If this is already changing how you see prices around you, subscribe. This channel focuses on patterns most people only understand after it's too late, and how to adapt before the damage is done. The next videos go deeper into protecting purchasing power when currencies weaken. If capital outflows continue, the outcome is predictable. A weaker currency means imports keep rising, wages fall in real terms, savings lose value. The danger isn't just higher prices, it's speed. Once confidence breaks, exchange rate moves accelerate, and reversing that takes years, not months. Countries don't bounce back quickly from currency weakness. They endure it. So here's the core truth. When big money leaves a country, your currency weakens. When your currency weakens, imports get more expensive. When imports get more expensive, daily life gets harder. Fast. This pattern isn't rare, it's repeated. The people who struggle most are the ones who don't understand why prices are rising. The people who adapt are the ones who recognize the signal early. In the next video, I'll break down what actually protects purchasing power during currency weakness, and which popular strategies fail every single time. Subscribe, watch the next episode, and stay ahead of the pattern. Because currencies don't collapse suddenly. They erode quietly until everyone notices at once.